Welcome to Shares from the American College of Financial Services, where we're invested in expanding your opportunities. Here's a look at what we'll be sharing with you today.
Or depending on what shakes out, I mean, is there something I should do now? I'm getting lots of questions. I don't know if you're just anecdotally hearing things like that as well.
Yeah. I mean, it's natural for everyone to be concerned, right? Or if they were planning on making a big purchase, do I wait now and see, or do I act now because it may get worse, more expensive later on?
Welcome. I'm Eric Ludwig, Director of the Retirement Income Certified Professional Program at the American College of Financial Services. And Sophia, a lot of financial professionals and their clients have been anxiously waiting for some hint about where tax policy is going to go this year, especially with the new political leadership. And one of the biggest focus has been on the continuation or the expiration of the changes in the 2017 Tax Cuts and Jobs Act. So in recent weeks, we've finally gotten a little bit of an indication on what some of those policies might look like. So here to break them down is Sophia Duffy, Director of the college's Tax Planning Certified Professional Program, the TPCP. So Sophia, welcome back to the podcast, and thanks for sharing your knowledge with us today.
Thanks, Eric. I'm excited to talk about this bill today.
Well, we were kind of joking before we recorded. We have like 100 different bullet points that we could go through. So we'll see how many we can punch through. I thought maybe we'd start with just like for a little bit of a refresher to kind of go through what is the TCJA, the Tax Cuts and Jobs Act, and why are we talking about it sunsetting now in 2025?
Yeah, that's a really great question. So, many of us remember, doesn't seem like that long ago, but it was that long ago. In 2017, the Tax Cuts and Jobs Act was passed, and it was probably one of the most transformational tax bills that had been passed in almost recent history, right? It changed the marginal rate brackets for income taxes. It introduced a lot of new credits, new deductions like the qualified business income deduction. And one of the interesting kind of aspects is that the way that congressional laws and tax laws need to be passed is that they kind of run on this 10-year time frame. So when tax laws are enacted or tax changes are enacted, typically the president that's in effect at the time that the bill is passed or the law becomes effective, they're not going to be president when the pain has to be felt, right? When, for example, those provisions are sunsetting and then the next president has to deal with the outcome of that. That didn't happen here, right? Now Trump is actually in a non-consecutive second term. And so his administration is going to be in place at the time that those tax cuts and jobs provisions are sunsetting. So what was speculated and what has largely come true is that a lot of the provisions that were enacted are either being made permanent at the time they were supposed to sunset at the end of 2025, or they're introducing new extensions, right, to the end of 2028. So we'll see, how that shakes out. The bill passed the House recently as of a couple of days ago, and then it still needs to go further. And we probably will expect more changes to come from that and more amendments to the bill. But largely, we're seeing what was in place is being continued, and some really new, exciting changes to deductions and other things like changes to what constitutes taxable income that we're going to talk about a little bit later.
Well, cool. Yeah, let's get into it. I know there's been a lot of talk about like the TCJA 2.0, or I think the media is calling it the one big, beautiful bill.
Right.
So why don't we just get into some of the key provisions that are in the current proposal, and we can start however you want, and then maybe we'll
Sure.
kind of dial down into some of the other ones.
Yeah, so I think one of the biggest changes, or one of the things that many people can take advantage of, is the changes to the standard deduction. So the marginal tax brackets are relatively staying the same, right? We didn't jump up back to 39.6 at the top rate like we thought was going to happen. But of course, they're going to be inflation adjusted. So we may see a little bit of change there. But then we also have a change to the standard deduction. So it's actually going to be increased to $15,000 for single filers, $30,000 for married filing jointly, plus an additional $1,000 increase to the standard deduction through 2028. So from 2025 to 2028, we'll get an temporarily increased standard deduction. And then there's also an additional, I guess they're calling it a bonus deduction, for individuals that are 65 and older, where they can deduct an additional $4,000. Now, this does start to phase out. I'll have to check my notes on the phase out ranges. So at $175,000 for single filers and $200,000 for married filing jointly. But if they're over 65 and they can take advantage of this bonus deduction through 2028, that should help with some additional tax savings as well.
That could be huge. Yeah, it seems like the whole like itemizing deductions is almost a thing of the past, right? These standard has gotten so high that
Yeah, the standardized, and also some of these new deductions that we're going to talk about. We saw this happen with the QBI deduction, where it is a technically below the line deduction, but it can be taken in addition to the standard deduction. So you don't need to itemize in order to take that deduction. What we saw with the Big Beautiful Bill is that they are introducing more of these types of deductions, like the deduction for tip income and some overtime income. That can also be taken in addition. So it would be interesting to me to see how they're going to categorize these new deductions. There should be some kind of name for it because they're technically not a below the line deduction. But yeah, we can come up, maybe speculate as to what those names will be.
yeah. No, it's funny you say that. I was talking to, and we'll get into this in a bit, but one of my airline pilot buddies was talking about the overtime thing, and we can talk about that in a little bit. I was telling him like, I don't know if that's gonna apply to you or not. But
Right.
let's talk about salt, and we're not talking about the shaker salt, but I guess I'll let you define it. But it's been kind of in the news again since 2018, and I'm curious about what some of the changes are that are proposed and who would be impacted by those.
Yeah, that's a great question. And this is actually one of the hot kind of button items because the salt is state and local taxes. And you typically get a deduction for those on your federal income tax return. As of the Tax Cuts and Jobs Act, though, the one that was passed in 2017, there was a $10,000 limitation on that deduction. So this sort of disproportionately affected high income earners who tend to have more than one residence, right? They may have a vacation home or more than one home, or they're going to live in high cost of living areas where they are paying more than $10,000 a year in local taxes. So that $10,000 cap has always kind of been a bone of contention. And there's a lot of push on both the red and blue sides of the aisle to increase that cap. So in this bill, what has passed so far is an increase up to $30,000, which could be very beneficial. But the downside to that is that it does phase out. And the phase out range for that is $400,000 for single filers and $500,000 for married filing jointly. So you're still, for super high earners, for individuals earning at the very high income levels, millionaires, those types of individuals, we're still going to see a $10,000 cap because it's going to phase back down to $10,000. But for those individuals who are in that sweet spot, they may be able to get a much larger deduction than they were eligible for previously.
That's really cool.
Yeah.
Okay, that makes sense. The other thing that I think has been on the list is 199A deductions.
Yeah.
I know this is kind of a nerdier provision that I seem to remember when like studying for my CFP. I remember reading the 199A business deduction. I don't personally work with business owners, so I'm not super familiar with it. So there's something going on there. I thought I'd let you, again, the
Right.
tax pro, get into what is this.
199A is the section number, right? But it's kind of known as the qualified business income deduction or the QBI deduction. And yes, it is a little nerdy. This is the one that probably I got the most excited about when I saw there were changes coming here. So generally under I'll say the old rules, you get a deduction of up to 20% of qualified business income. And that means that anyone who owns and this is only eligible for pass-through entities, but that means that they could deduct up to 25% of their business or 20% of their business income. And that essentially is, tax-free. The new bill has changed that. They've increased the percentage up to 23%. But the more exciting change, I think, is that under the old laws, specified service businesses, which generally were attorneys firms, CPA firms, really service-based industries, even financial advisory firms, they were phased out of the deduction entirely above a certain threshold level. So let's just say for married filing jointly, that's $400,000 right now. It's somewhere around that amount, and that's indexed for inflation. Under the new bill, that phase out has gone away. And now you may be eligible for a deduction above that range, above that threshold, depending on a certain calculation. So essentially, that 23% that you may be eligible for is going to be reduced by 75% of the income over the threshold. So essentially, 75% of your income over $400,000 is going to reduce that eligible QBI deduction of 23% of business income. So what does that all mean? Well, the numbers, of course, are going to be different for everyone, right? Because QBI is business income, but the threshold is based on total taxable income. So that's going to include spousal income, for example. Where this deduction can really make a big difference is if you've got one spouse that, say, owns a pass-through entity and their QBI is very high, and then the other spouse may have, let's say, a salary job, they're an employee, and their income is much lower. So let's say their income is, 10, 15, 20% of the total taxable income for the household. You could still get a pretty substantial deduction. And it'd be interesting to see the Tax Foundation does really wonderful analyses on, at what level will this eventually phase out. But we're probably going to see business owners who earn $600,000-$700,000 a year, depending on what their spousal income is. They could now be eligible for a deduction that they did not, they weren't able to claim previously. So that could be pretty exciting for them.
It is, yeah. Like you said, a lot of these, it seems like, oh, cool, there's deductions or whatever, but they sort of phase out and you're like, well, neat, not for me. But
Exactly.
And like you said, this is specifically for service businesses like financial advisors. So the folks listening to this, not only is this beneficial to hopefully some of their business clients, but themselves as well, which is kind of neat.
Exactly. And for planning tips, it will largely stay the same. We're going to do everything we can to try and reduce that taxable income. So your QBI income may be very high, but then taxable income, you want to take advantage of things like retirement contributions. Of course, maybe small business owners want to explore options for changing their retirement plans to something that maybe they can contribute a little bit more towards to get that taxable income lower. And then also the new bill made permanent the 100% bonus depreciation, as well as the 100% deduction for research and development costs. So business owners can now start to explore ways to reduce their taxable income by investing in, depreciable assets and research and development if that aligns with their business.
Interesting. Okay. So yes, is that still for the service type of role, or is this a different thing, the R&D?
Yes. Yeah. Well, yeah. I mean, I can't off the top of my head think of specified service businesses that would invest heavily in R&D, but there may be some floating out there. But definitely for the depreciable assets, right? So if they want to make capital investments in their businesses and then bring down their taxable income, that could help them to realize more of that QBI deduction.
Oh, I see. Okay. Yeah. So they work in conjunction. If you're not getting the service side, this is the capital asset appreciation part of it.
Right, because everything they can do to sort of bring down that taxable income number is going to shift that balance, right, between my 23% QBI and what percentage of my income is over the threshold. So the more we can get that number, that difference to be more exaggerated, then the more eligible they'll be for a deduction.
Okay, that makes sense. All right. So now if I retake my CFP exam,
yeah,
more knowledge.
And again, we'll see how it shakes out, right? We don't know if this is going to be the final law, but it's just interesting, and it's could be a very significant opportunity for small business owners who thought previously, I'm not eligible at all, I make too much, and now they can start to structure some of the purchases for their business, some of their expense management, so that they can be eligible for at least some of the deduction.
True. Yeah. And we think this is supposed to go to like you said, it passed the one and it's going to the other part of Congress soon, right? So this is something we hopefully will hear. I think July 4th was kind of the intended target, if I'm not mistaken.
Yeah, we should be hearing very soon. And it seems like most of the big provisions have sort of been settled on. But again, we're going to see some changes. I'm sure we'll see changes to things like the cap deduction or the cap limitation, and even some of these business owner deductions as well.
Well, one thing, we kind of hinted at this before. I think, if I'm not mistaken, that when Trump was on the campaign trail, he had this no tax on tips idea, right? And so I kind of hinted at one of my airline pilot buddies was asking me about the, like actually he was going to fly over Memorial Day weekend. I'm like, ooh, interesting
overtime
thing coming down the pike here. So talk about that a little bit. What should we know about some things that, these are showing up?
Just last week, I just happened to meet at a function, an individual who works for the IRS, and I was just kind of picking his brain on what the thoughts from the inside are on this. And I asked him, do you think that this provision was passed to try and encourage more individuals to report tip income, right? Because we know that a lot of tip income is potentially, made under the table and not reported. And he didn't have any specific insights. He was, an employee at the IRS that didn't kind of work in this space, but he generally seemed to think that it was not geared towards getting more taxable income reported. It was really trying to keep a campaign promise, right? And do that in a way that kind of made sense, or at least tried to make sense in a fiscal way to make good on that promise. But yeah, the no tax on tips and no tax on overtime is a bit misleading because they are still going to be subject to payroll taxes, right? So it's only the other income tax side that we're worried about here. And on tips, they've done it in a way that I thought was very smart, which is that they put restrictions on what tip income is, right? You can't just shift everyone in your business to a tip saying, okay, now you get no salary and you're only tips. It has to be a business that traditionally earns tip income. And I'm sure that you are aware, and we all have kind of noticed that ever since the pandemic, more and more businesses that weren't generally tip industries were asking for tips, right? So even I ordered something online the other day from it was a handmade item, and they were asking for a tip, which you wouldn't necessarily think that that's kind of a tip generating activity because it's not a service, but it has to be a traditional tip industry, right? Like a service industry. It also none of these apply. This provision does not apply to highly compensated employees, which is about anyone earning around 160,000 and over. So it's only going to be for lower income or individuals who earn less than that. The other kind of restriction here is that an individual can't shift, if they were on the overtime, that the non-taxable portion is only the amount above what their standard hourly wage was. So if someone is earning 2.5 times their hourly wage in overtime, it's only the extra over what they would have made normally that is not subject to taxes or not subject to the income tax then. The biggest thing I think is, again, these are below the line deductions, but they are taken in addition to the standard deduction, just like we talked about with the QBI as well. So they can be taken in any event. And the other deduction too that was in this category was auto loan interest. Do you want to talk about that for a minute?
Yeah, go for it. I was going to say I know we had a bullet point on that.
Yeah. So auto loan, you can get a deduction for up to $10,000 on a new loan for cars purchased between 2025 and 2028. The car does have to be assembled in the United States. So that is, again, kind of a campaign provision that we heard, of trying to get more jobs back in, and to supplement the manufacturing industry for car manufacturers. One thing that I did notice that was interesting is it specifically excludes new loans taken on cars that have already been paid off. So for individuals who have cars that were paid off, you can't take out a loan essentially on that car and have that qualify. It has to be on a new car loan.
Bummer. All right. Well,
Yep.
Last year I did buy a 2025 truck in fall, but I paid cash, so I guess.
Yeah.
Too bad for being fiscally responsible.
Right. Yeah, exactly. And we'll talk about that at the end, maybe some timing kind of tips that we can see, what things to look out for on the horizon and things we might want to wait on to see, until this bill actually shakes out.
Your one-stop shop for valued and valuable CE is here. Introducing Knowledge Hub Plus, a new just-in-time learning platform from the American College of Financial Services. Enjoy access to the profession's best and brightest, with over 60 hours of college and CFP board-approved CE from more than 35 trusted academics, practitioners, and industry experts. And with new CE added monthly, exclusive live webcasts on timely topics, and built-in automated reporting, it's never been easier to get the answers you want while earning the CE you need. Know now with Knowledge Hub Plus. Learn more, subscribe, and expand your expertise today at theamericancollege.edu/Knowledge Hub Plus.
I do feel like, just kind of anecdotally, I'm hearing questions about, like we saw recently, there was questions around what if Apple is forced to sort of make production within the US, like, is that going to drive prices up? And should I just buy my new iPhone now? And same thing with autos, right? Too. It's kind of a similar thing where, depending on what shakes out, I mean, is there something I should do now? I'm getting lots of questions. I don't know if you're just anecdotally hearing things like that as well.
Yeah. I mean, it's natural for everyone to be concerned, right? Or if they were planning on making a big purchase, do I wait now and see, or do I act now because it may get worse, more expensive later on? And I think for an iPhone purchase. Maybe, it is expensive, but it's not a sort of life-changing purchase like a car or buying a house, for example. So they may want to sort of pull the trigger on that earlier, because even if it ends up becoming less expensive later or the tariffs don't go through, they haven't lost that much. But it's really just such a personal decision of how much risk they really want to take, right?
That's true. Yeah, it's like you're taking uncertainty off the table by kind of
Yeah.
pulling the trigger on it.
And for cars, I mean, until this bill becomes finalized, you may see more car dealerships offering more flexible terms, maybe willing to negotiate more on the price because they want to get some sales in now. Whereas most people are saying, well, no, I'm going to wait because I want to see if I can, get this deduction. So this also may be a good time to negotiate.
Yeah, that's a great point.
Yeah.
Well, that's interesting. I'm going to shift gears a little bit. There's been some talk on two different account types. One of them we've heard of, one of them we've heard about in the news. So the one we've
Right.
heard about is HSAs, health savings accounts. There's some interesting things going there. I thought you could talk about, as well as the new sort of MAGA accounts. I thought you'd
Sure. Yeah.
have
Yeah.
some
So
points on that.
again, I think these are exciting, potentially opportunities. HSAs, we at the college just generally love HSAs, right? We think that when it makes sense for an individual, they should certainly take advantage of them because they have so many tax benefits. And I really love this provision of the bill because it makes HSAs more flexible, easier to use, and more attractive to use. HSAs generally are only permitted, these health savings accounts are permitted for individuals who are enrolled in high deductible health plans. And this has scared a lot of individuals from enrolling, right? Because they think, oh, the deductibles are too high. Maybe my medical costs are going to be high in a year, and then I'm going to get, the short end of the stick there. But the bill provides for a few things that I think make these much more attractive. The first is now, unlike previously, if an individual enrolls in Medicare Part A, they're no longer automatically disqualified from contributing to an HSA. And that is a big change. And I think also because the way that Medicare works, you have to apply, and then you kind of have this 6-month look back period, essentially. You had to stop contributing to an HSA before that 6-month period. So people didn't realize that. Sometimes they kind of missed the window, and then they had to either delay or they weren't able to contribute. So here, that Medicaid Part A enrollment doesn't automatically disqualify someone from maintaining their HSA, which I think is wonderful. And now an individual can have a spouse that does have an FSA through their employer that doesn't disqualify them from contributing to their HSA either, which is, again, making it more flexible. The one that I'm most excited about, just personally, is now we can use HSAs to pay for gym memberships for up to $1,000 a year. Yeah, so I know you and I are friends on Strava, so that's important for both of us. Again, making it more flexible. And I think generally we're seeing this push. We see with HSAs, the changes to 529s to try and get individuals and encourage them to save in these tax advantage plans, right? So that they can realize either tax deferrals or tax exempt earnings, and sort of encourage people to take a more proactive approach in their saving, which I think is a great benefit. The other change to HSAs is that if an individual enrolls in a high deductible health plan, they can take their unused FSA money or HRA money from a health reimbursement account and roll it over into their HSA. So for those individuals who didn't want to enroll in a high deductible plan because they had FSA money they were going to lose, now they can port that over, which again makes it more attractive for individuals.
That's actually pretty big, right? Because like you said, a lot of employees, they're like, oh, well, there's this FSA account, but if it's the use it or lose it idea, right? And this changes that.
Exactly. Yeah. So I think that all of these changes are very positive, and they encourage individuals to just explore whether any high deductible plan is right for them. For the MAGA accounts, so these are accounts where for children born between 2025 and 2028, an account can be opened for them, and it's automatically sort of seeded with $1,000. Which is great, right? It's free money. And then an individual can contribute to that account up to $5,000 per year until the child turns 18. This one is, if it's available and it's there, I don't think there's any harm in taking advantage of it. But compared to some of the other accounts that we have available, there are some restrictions that may make these accounts a little less attractive to use, I would say, as the sole funding method for the child's needs. For example, when you compare these to an UGMA or an UTMA account, there's some real restrictions that may make these a little bit more unattractive. So at the end of the day, maybe it's worth it just to open one and get the $1,000 and just let it sit there. But just by comparison, there's no distributions permitted before the child turns 18 in a MAGA account. But in an UGMA or UTMA, there are distributions permitted, right? So if a child has a medical event or educational needs, they can take distributions from an UGMA or UTMA account. The tax treatment is a little bit interesting as long as it's a withdrawal for a qualified expense. So after 18 up to age 25, you can take a withdrawal, actually up to 31. Essentially, you can take distributions for education, buying a first home, small business funding, which I thought was interesting, credentialing costs. That is a qualified distribution, and those will be taxed at capital gain rates. A non-qualified distribution is going to be taxed as ordinary income. Now, the downside to that, though, is if you're funding when the child is a minor and then we're taking distributions when they're 31 or between 25 and 31, they're likely to be in a higher tax bracket, right? So even if you're taxing at capital gain rates or ordinary income, it's likely they're going to have more tax assessed at that time, at the time of withdrawal from the account, compared to an UGMA or UTMA account where it's taxed annually. And yes, you're subject to the kiddie tax rules while those apply, but you're getting that tax impact while they're still fairly young, as opposed to, older when they may be more established in their career.
So is that the idea? Is these MAGA accounts and the earnings would be deferred until down the road?
Right.
That's the idea. Okay.
Correct, right. And we can take distributions between 25 and 31, and then the account needs to be distributed at age 31. But between that 25 to 31 range, that's where either you're going to get the capital gain tax treatment or you're going to get ordinary income tax treatment, depending on what the withdrawal is for.
Okay.
Yeah.
That makes more sense. And did you say, though, the other part of this was they had to be born, the idea of this is that they had to be born in like the next few years, right?
Correct, between 2025 and 2028. But the account can be opened up until they turn 8 years old. So they don't need to be opened during that time frame. It just is the eligible time period.
Okay, that makes sense.
Yeah.
Interesting.
And again, we'll see if that changes. But in conjunction with something like a Roth IRA when they're working, or a 529 or an UGMA, I think it can be a very valuable tool, but perhaps not the sole kind of savings mechanism for a child because of those tax restrictions.
That makes sense. Yeah. It's like diversifying the tax treatment of accounts, right?
Yeah, absolutely. Yeah.
Yeah.
On that note, do you also want to chat quickly about the changes to 529s? Because that is pretty exciting for us at the college.
Absolutely. Yeah. It's very exciting.
Yeah. So 529s, the just like HSAs, we saw an expansion in their utility, right? We're seeing many more types of expenses qualifying under a 529. For example, now it's not solely limited to just tuition. We can have books, supplies, laptops, those types of things can also count as a qualified expense under a 529. What's the biggest change, I think, is that now professional credentialing can also you can also utilize a 529. So that means CFP education, any of our designations, that's all credentialing expenses that can be counted, as well as exam fees and continuing education as well. So for individuals like advisors who, especially RIAs who may be funding that education on their own, now the 529 can help provide sort of a more effective, more cost-effective means of funding that continuing education.
I love that, right? Because you could, if you know that you're going to pay the tuition anyways, get the deduction, then take the distribution from the 529 and.
Absolutely. Yeah, absolutely. And they for programs like the RICP and the TPCP for individuals who have money in a 529 and maybe it's just sitting there and they didn't really know what to do with it. Maybe there wasn't another beneficiary. This would be a wonderful way for them to advance their career.
Yeah, that's huge. Yeah. So it's like the tax benefit, and you can learn about TPCP all in one.
Right. Exactly. I think that's the main points. Just a few other things that I thought were interesting is probably not surprising based on what was happening during the campaign, but some of the restrictions, for example, the deduction for tips and overtime, the child care tax credit, or child tax credit, excuse me, those are now only eligible for individuals where both taxpayers, if they're married filing jointly, or they're just married, they need to have Social Security numbers. So it'd be interesting to see how many sort of couples in the United States where maybe one was a citizen and one is not, how many of those now are ineligible for claiming some of those deductions and credits, because now essentially only citizens can utilize those.
Interesting. What would be like, is a clean energy credit, is that like electric car purchase or something like that? Or what would an example be?
There were, for making improvements to your home, and I think for EV cars, those have all been repealed. The ones that I was talking about, I might have misspoken, it was the child tax credit. So now that's only eligible for citizens, as well as the deduction for tips and overtime as well.
I got you.
Yeah, okay. So if an individual is married, they both need to have Social Security numbers in order to claim those. Again, we'll see if that makes it to the final bill based on what's going on when it goes through the next part of Congress. But that may end up making a pretty big difference for individuals who have non-citizen spouses.
Yeah, that's interesting. That will be interesting to see how that shakes out. Well, so we've talked about a ton of things here that are kind of up for grabs, some highlights. We always, the idea of the American College is to provide applied financial knowledge. So I'm curious, if you were sort of advising an advisor, are there some things that would be good, thoughts that they should be thinking about, talking either with themselves or with their clients right now?
Yeah, I mean, you and I, before the podcast, we were chatting just about a story of an individual who was an advisor that I was speaking to, and their client was so worried about the marginal rate going back up to 39.6% that he converted his entire IRA in 1 year to a Roth, and the balance in the IRA was over $6 million. I forget the exact amount. So he took that whole tax hit in that year. Now, obviously, he had the funds to be able to do it, right? Obviously, we're talking about somebody who could take that tax hit, but that story is just to show or to demonstrate that sometimes the wait and see approach may be the best approach, right? Especially here where we don't have anything that's finalized yet. And most of these changes are not going to go into effect right away, right? So we have, if the bill passes and becomes finalized sometime in June or July, we still have several months in the tax year to try and take advantage of some of the some of the planning strategies. It's not like this is passing in November or December where we may be panicking. So wait and see. And for those individuals who are small business owners, or like we talked about to make their first major purchase of a car or a home, maybe just put some options in place as an advisor for your clients, and then be ready to implement on them once the tax bill is finalized. But making a sort of rash decision immediately just to save some number of dollars in taxes is probably not going to be beneficial, or maybe in hindsight could have been executed in a more tax efficient manner for clients.
That makes sense. Yeah, because it doesn't sound like anything that we've talked about today would be affected by we had to get this done before the rule was passed, right? It's like you said, if it does get fully passed, there's still several months of planning opportunity.
Yeah, I think exactly. If somebody's making a decision about whether they want to take a designation, for example, maybe not that we would want people to, but maybe wait to see how the bill turns out, right, before they make that decision. For business owners, maybe doing an analysis of their expenses to see, all right, if I do invest in some depreciable assets, how is that going to affect my deduction? Maybe for open enrollment, right? For individuals who have open enrollment coming up later on in the year, explore now whether converting to a high deductible plan might be worthwhile, right? Because of all of the new advantages that we have with HSAs. So at this point, it's, I would say, a research period, right? So see if we can take advantage of some of these provisions, and then again, be ready to implement that once the final bill is rolled out and we know exactly what that impact is going to be.
Right. Yeah. So this is education time, and then maybe communication with clients, right? Like I'm thinking about these advisors that have clients that are business owners. It's like, hey, not that we're necessarily recommending anything at this point, but it seems like a great opportunity to at least demonstrate your expertise. Hey, I listened to the podcast. I read some of the news articles. I just want to reach out to you about some things that are coming down the pike, and then go from there, and then just kind of set up the follow-up meeting for whatever this fall to actually do something about it, right?
Exactly. And then the sort of hard work is done by that point, so you can just move forward.
Yep, I agree. Well, this has been super fun, Sophia. I've learned a lot. We were joking before we recorded that I was just going to ask you one question, which was, hey, what's in the tax bill? And that's pretty much what we did. I was able to just ask you what's coming down the line here, and you did a great job. This was super exciting. I know people are going to enjoy this. If they wanted to learn more about TPCP, of course, go to the college's website. I don't know if you want to give a plug for it, but it's not necessarily. Well, go ahead. I'll let you.
Yeah, sure. Yeah, I would say an advisor-based program, meaning it is not a compliance-based program, right? We're not delving into the mechanics of how to complete a tax return, on behalf of clients. It is about strategy, and the program sort of follows the life phases of a client. So income accumulation, right, in retirement, and then of course, sort of end of life and special circumstances planning. And in each of those phases, we're really just talking about if a client is in a certain situation, what are the tax sort of mitigation or tax strategies that can be implemented or offered to clients so that they can take advantage of some of the tax minimization over a very long-term horizon. So it's a little bit different than, CPA education, where we're talking about what has happened and maybe how to reduce taxes in the immediate time frame. This is really over the client's long-term planning horizon.
I love that. So many things that we've talked about today that are coming. Sounds like there'll be some new planning opportunities.
Yeah, we'll have our work ahead of us at the college too, to make sure that we're keeping all our content up to date. So one of the things with the tax program was we are making changes in real time. So we are keeping on top of what's happening with the bill, and we will be changing, the course materials accordingly. So at any time someone is enrolling, they'll have up-to-date materials.
Awesome. Well, this has been so fun, Sophia. I really learned a lot personally. I know everybody listening to it is going to have a lot of nuggets and takeaways. So thank you so much for sharing your knowledge today.
Yeah, thanks for having me. Good to see you.
That's all for now. But you can find all our episodes on YouTube, Apple Podcasts, Spotify, and most other streaming services. Be sure to like us, follow us, and leave us a rating and review. Shares is a production of the American College of Financial Services, and we hope you join us next time as we share ideas that expand your opportunities.